Our banking system is sound.
In the past 2 weeks, serious difficulties at a small number of banks have emerged.
These banks are safe.
All depositors' savings in the banking system are safe.
The banking system in the United States is sound and resilient.
Banking system is sound. Banking system is sound. Banking system is sound. Banking system is sound and resilient.
A rough week for the banking industry.
The collapse of Silicon Valley Bank, the second biggest bank collapse in U.S. history.
The Silicon Valley Bank collapse is the worst since 2008.
Social Security is structurally sound.
As president, I will not cut one penny from Social Security or Medicare.
There's an imminent disaster waiting. I mean, that's where we're headed.
2 balls, 2 strikes to Bryce Harper. Suarez delivers. Swing and a drive. Left field. It's deep. It's going. Yes! And it is gone. Yes! It is bedlam at the bank as Bryce Harper has put the Phillies on top.
Thank you for tuning in to podcast number 11 of Bogus Banks, Behemoth Bubbles, and Baseball Betting. I'm your host, Chase Goldman, and today is Sunday, December the 21st. So on the conspiracy trade, I'm not going to go back over how the conspiracy trade was arrived at or the logic behind it. You'd have to go back and listen to podcasts 4 through 10 to get a recap of that. I'd probably say 10 was the quickest and easiest one to understand. But the trade is still alive. The markets are headed up the last 2 days, big, on Thursday and Friday. But there was some big news that came out for the Bears that I felt like was a big win, and that was when Blue Owl Capital pulled out of a $10 billion funding commitment on an AI data center up in Michigan. So what this is telling me is it used to be you just shot AI and snap your fingers and people would write you checks for hundreds of millions of dollars and you could go do whatever you wanted to with it. That's getting to be a little bit harder to do now. So it's not as easy to raise capital. So 24 hours after that, we had Sam Altman come out and announce that he is going to be able to raise $100 billion. I think he's supposed to have it in late January is what I thought I read. If that guy is able to raise money, I'm just going to know that that'll just prove to me how fake these markets really are. After that interview he had on that Zoom call with his investors, where the guy said, "Hey, Sam, how are you going to spend $1.4 trillion over the next few years?" He says, "Hey, I can find somebody to buy your shares." Enough. Okay, if that guy is able to raise capital, oh boy, I got in the wrong business. I should have been a white-collar crook because they never go to prison, ever. Although that tricolor guy, apparently they did charge someone with a felony on that this week, which I was glad to see. So if you're not following along with that, tricolor was guilty of pledging, double pledging, and triple pledging their collateral, which is just open, outright fraud. So I was glad to see that. But going back to the other thing that led the markets higher on Thursday, well, there was another thing on Friday. I think Thursday night, Amazon announced that they're going to be buying this new consortium is going to own 50% of TikTok, and apparently that's for national security reasons. And somehow Amazon's going to wind up paying I don't know, I think they're going to pay a couple $2 billion for their share of it. And apparently it's a sweetheart deal, pretty much brokered by the Trump administration. So they pretty much stole that half of TikTok, and Amazon got a great deal on that, but I don't know if that's going to be enough to save them with their spending plans and the amount of cash they're burning on this stupid AI shit. We'll see what happens. I think they're going to have to dilute their shareholders at some point, is my prediction. Okay, so let's go back to the conspiracy trade. We did come very close this week with the Thursday and Friday just run up. But yeah, we had the Sam Altman promising to raise $100 billion. We had Amazon getting a freebie from the Trump administration on TikTok. And, prior to that, though, we had this Blue Owl Capital saying, hey, we're not going to put this $10 billion into this AI data center up in Michigan. So I felt like that one was far worse than Altman saying, hey, I hope to raise $100 billion. Until you've raised it, just shut the F up, man. You ain't done shit. Show me the money. He hasn't shown anybody anything. He's just talk at this point. So we'll see how that goes. But that's enough for the conspiracy trade. We're going to see how it goes. We're about, I think on Friday's close, the S&P 500 was 1.2% below its all-time high set on October 29th at 6,920. That number still has not been breached in 36 trading days. 7.5 weeks that trade has been alive. Will it die this week? I honestly wouldn't be surprised. I still think I saw something with the 1029 and the giant sign about the stock market crash and Andrew Ross Sorkin ringing the opening bell in front of it. Nobody rings a bell. I really think I saw something. We will find out. But it's going to be a slow news week for the next 2 weeks. We got all these holidays coming up. I just don't see anything really moving the market. We will see. But I fully expect the stock market to drift up, and if it does at all, that trade's over. We're going to violate that 69.20, the all-time high of October 29th. We will see what happens. I still think these markets are fake, but on the assumption that they're not, this whole entire thing about the Cayman Islands has not been sitting well with me at all. So I think it was around mid-October, the Fed had issued a report that they had investigated some things and realized that there was way more money in US Treasuries being held by the Cayman hedge funds than previously thought. And so I started asking one of the chatbots a lot of questions about this, and I think I've learned some things. So the reason that the hedge funds domicile in the Caymans is because they're not restricted on their leverage, the amount of leverage they can take up. And then there's other tax reasons to be out there as well. But the main one is the leverage. Apparently, I'm going to assume that they can't have that kind of leverage if they're domiciled in the United States with treasuries, US treasuries. There are probably restrictions on it, but as long as they're a Cayman hedge fund, then they're allowed to do it. So basically, these Cayman hedge funds are just off-balance sheet special purpose vehicles of the primary banks. Now, just to let you know what a primary bank is, the primary dealers are the ones that get to bid on the U.S. Treasuries when they have an auction. And that would be your really big banks like your Wells Fargo, Goldman Sachs, JP Morgan Chase. Those are the big banks, okay? Those are the only ones that get to play in that market. But to assume that these Cayman hedge funds are a completely... That is such a good old boy system. They would never, ever let me or you or anybody else that we know in our circle go be a hedge fund out in the Caymans with U.S. Treasury market. But what they do is they will, let's say, for example, a hedge fund in the Caymans, they have $1,000 in capital. Now, what they'll do is they will loan that $1,000 to the U.S. government, and they will buy, let's call it a 10-year T-bond. Now, they don't like to buy bills because they're trying to play this off in the futures market. But what they'll do is they'll buy that T-bond with a certain predetermined yield for the 10-year, and right now it's around 4.2%. Then what they will do is they will go into the futures market, if I understand it correctly, and they will sell a futures contract. And they will deliver that T-bond at the end of the futures contract. And the futures contract has a little bit higher, it gives them, so in other words, the seller on that, the buyer on that, so they're selling the futures contract. The Cayman hedge fund is going to sell the futures contract, and the buyer of that futures contract are pensions and people that just don't want to have to deal with, coupon payments and everything else. They just, and plus the main reason that the pensions do it is because they can get $1,000 of exposure to the T-bond market or the T-note market for $50. And the same is true for the hedge fund. They put up $50 of collateral, and now they can sell their $1,000 bond, but they don't have to actually relinquish the bond, right? So what they'll do is the hedge fund has that bond, and then they will go to the repo market, and they will sell that to the primary dealer. The primary dealer gives them, they'll loan, Gemini was telling me sometimes 0% haircuts, but let's just call it a 0.1% haircut. So they'll pledge a $1,000 T-note with their primary dealer, and they'll get $999 cash that's just sitting there in their bank account. So then what the primary dealer does is they didn't have that $1,000 to begin with. So what do they do to find that $1,000 to replace it? Because they need to replace that $1,000 they just gave the hedge fund. So they go and they take that T-bond and they repo it to the money market funds. So the money market funds buy that, and they give the primary dealer $1,000 for that T-bond. See how that works? Now, everybody that's buying the T-bonds, or the money market funds, I'm sorry, everybody who's buying those money market funds, they think that what they're buying is nothing but T-bills, when in reality, those money market funds are buying T-bonds from primary dealers who bought them from Cayman Island hedge funds. So we have a real mismatch on the maturities at the money market funds, and it's estimated that now, I think they originally, the Fed report said that, oh, we've underestimated this by 1.4 trillion. So at the end of 2024, there was 1.85 trillion dollars of US Treasury securities held by Cayman funds, and that number today is estimated to be somewhere around 2.5 trillion. Okay, so everything's great and everything's fine right now, but then why did the Fed have to start QE 2 weeks ago when they had their last FOMC meeting? Why are they going to be buying Treasury bills? Okay, well, let's just go back and see what that hedge fund's going to do. So they're going to take their $1,000, they're going to loan it to the government, they're going to get a T-note. They're going to take the T-note and use that as a delivery in case the market moves against them. They have that T-note sitting in their account that they can use in the futures market. So they can deliver on this futures contract that they're going to sell, and then the pension is the one that's going to buy that. So each one of them only has to put down $50 a margin, right, for that $1,000 T-note. And they're both exposed to that on the interest rate. So one of them was going to, so let's say that that things move, and they move one way or the other, then you would have a 5-cent, or say a $5 loss on that $50 of margin that they put up. You might have that $5 loss on the hedge fund side, and you'd have a $5 gain on the pension side, or it could be the opposite way around. But when these things get really volatile, then what you can find is that the futures contracts don't move as much as the underlying bond, and that's where you can run into problems as well. But let's go back to the leverage. So they take the $1,000, they pledge it out, they get $999, they go back and wash and repeat. So what they're going to do is they're going to take the $999, they're going to loan that to the U.S. government, they're going to get another T-note for $999, they're going to pledge that as collateral. That's the way I look at it, but they're saying that it's a sale, it's a repo market. They repo that overnight to their primary dealer. Their primary dealer gives them $999. Now the primary dealer is short $999. So where do they get it? They get it from the money market funds. So who are the people that put money on the money market funds? That would be, a lot of it is corporations. When you're reading through a corporate balance sheet or an earnings report from a company like IBM, for example, and they say that they've got, I don't know, $13 billion of cash and cash equivalents at the end of the quarter. Okay, what that is I would think that most of that's going to be in a money market fund. Now, they could go to feddirect.gov or whatever and buy their own, do it themselves, but God, that would be a lot of work. So probably what most of them do is they just put it in money market funds, because the money market funds are too big to fail. They're not going to allow the money markets to fail. I mean, I just don't see it in a million years. So those CFOs of those corporations, those publicly traded corporations, they're keeping a lot of money in these money market funds. I had a friend of mine who was also basically a CFO of a small company here in Dallas. They had about 25 locations, and that's what he did. He kept it in money market funds, a lot of it. And then you would just keep enough on hand and checking to make payroll and pay the lights and rent and things like that. But then also, investors also park their money in T-bills. There's a saying going around over the last couple of years called T-bill and chill. And that would be just, because you don't want to buy into the bubble, put your money into T-bills. That's what Warren Buffett's been doing. He is now the world's largest holder of U.S. T-bills at $400 billion is what I've heard. So that money goes into those and so all those people that are investing in these money market funds are buying into this, expecting that they're just buying nothing but T-bills. And on the surface, that is what they own, but behind the scenes, they own these T-bonds and T-notes that the hedge funds in the Caymans have created out of thin air with this. Well, they didn't create them out of thin air. I don't want to say that they created the money out of thin air. But what they've done is they've put all that money and just leveraged it. So basically, your money market fund is backstopping a 99-1 leveraged Cayman Island hedge fund that isn't even buying T-bills, they're buying T-notes. And so I think the reason that the Fed wanted to come in and do this QE, they're not calling it QE, but let's call it QE. Let's call a spade here. They're going to be buying $40 billion worth of U.S. T-bills every month. And the reason that they're doing that is because they want these primary dealers to be flush with dollars so that they can backstop anything that might go wrong in the T-note and the T-bond market. So that's where we're at today. And what would cause this to blow up? Inflation. Higher inflation means investors need to get a higher return on their longer-term bills and notes and bonds. Remember, inflation is the enemy, the mortal enemy of debt investors. So notes and bonds are destroyed by inflation. That's the enemy of notes and bonds. And so even though the Fed can control the overnight lending rate on the repo market, and so that gives them a lot of control over 4 weeks and 8-week bills and even out to a year. But once you get beyond that, and once you get very far into the future at all, that's where the market, allegedly, if we have a real market, and it's not a fake video game, that's where the market pretty much says, hey, this is what we think. And they price these things accordingly. At least I think that's what we're supposed to believe. I still have a hard time with that story. But at any rate, by backstopping the primary dealers with all of these T-bills, they're going to have the cash and the dollars needed to provide the liquidity if the T-bond market and the T-note and the 10-year market starts to implode, which I think it will. So let's go back. If you remember from a couple podcasts ago, a year ago, I went down to the Walmart near my house because I don't trust the government reports. And, that's just so maddening. They came in Wednesday morning with their CPI. That's the government report. And you remember, for the whole government shutdown, we didn't have to worry about, government reports moving the market an hour before it opened. It just didn't happen. It was just a thing of the past. And so my working thesis is, nobody believes the government reports, but because it's a fake video game, when they issue a government report, they want to gaslight the people and make everybody think that everybody else trusts these numbers. So they move the market massively up or down based on these non-farm payroll reports, the CPI, the PPI, all these stupid government reports they give us. And they also do the hedonic adjustments on the CPI. So they play that game too. So like they're going to say, okay, well, the new car that we sold last year has gone up by $3,000 this year, but look at what you're getting this year that you didn't get last year. This year's model has power windows. Last year's model had cranks on the windows. So they find little things like that and say, well, because of the power windows versus the cranks on the windows a year ago, those are worth $1,000. So the price of the car only went up $2,000 and not $3,000. Those are the games they play with hedonic adjustments. But when I went to Walmart a year ago, what I did was I found 40 items on the shelves of Walmart that I thought that exact same item would still be on the shelf a year later and it would not be changed. It would be the same exact product. So for example, on my list, my things at Walmart, I had a TV tray. I had a bottle of NyQuil. I had a package of salami, but it was a certain brand. So I made sure I got the same brand. So I'm comparing apples to apples on everything. And so, I was kind of blown away. I didn't feel like it was really that much of a year of price increases until just recently it feels like they're kicking in. But the average price increase on those items was 9.1%. So Wednesday morning, the government comes in and says the inflation rate was 2.6% year over year. And supposedly the market believes that because NASDAQ went crazy. It went up like 450 points that day. And the reason is you don't have this fear of the bond market demanding higher yields to compensate them for a declining purchase power, so higher CPI. So that's where the Fed doesn't really, unless they do QE, they don't have control over the long end of the curve. That's I'm talking 10 years and out, 10 and 20 and 30-year bonds issued by the US Treasury. So I think that we are going to get. How much longer are they going to keep lying to us about this? I was in Lowe's about 3 weeks ago and then earlier this week because I'm doing a lot of work around my house. And I was talking to one of the guys who worked there. And yeah, they're like marking up just about everything in the store over the last couple months. Everything's been going up in Lowe's. Both these people that work there knew it. And so I don't know how much longer the government's going to continue to lie to us and tell us inflation is only 2.6%. But apparently this bond market is the people that run the bond market, they don't go to Walmart. They don't know how much groceries cost. They've just got blindfolds on. That's what makes me think the whole markets are just fake. But if they start coming in with hotter inflation reports, what I think will happen is when it happened in 21 and 22, every time they'd come in with a hot inflation report like that, gold would get killed because everybody says, oh, well, now the Fed's going to raise rates. They're going to raise the rates to fight inflation, which is very, very bearish for gold. So they would dump gold, and gold would go down $50 an ounce, 60. Those were big moves for gold back then. Now they're not so much anymore. But I think gold's not going to experience that this time because, the bonds are going to get killed. Yields are going to have to jump to compensate people for higher inflation rates, but the Fed is cornered this time. Everybody knows that the reason they're lowering rates is because the government can't afford to make its interest payments with higher rates. That's why they're doing this. It's not, why? I mean, you've already got this booming economy that Trump keeps bragging about and all this AI spin going on unceasingly. And, you think you need to lower rates into that and make money even easier to obtain? No, it doesn't really pass the smell test with me at all. Of course, I also believe that these markets still might be fake because who in the hell was loaning money to the US Treasury at 0.5% back in 2020, right after the Fed had literally created $4 trillion out of thin air on their balance sheet? So you had more dollars chasing the same, or actually at that time it was fewer goods and services. We had fewer goods and services to spend our money on, and the money was created out of thin air, $4 trillion. Well, the reverse repo is now down to $3 billion, which means it's pretty much empty when you compare that to its all-time high. New Year's Eve, I think it was 2022, that was $2.5 trillion with a T. It's down to $3 billion now. So where does the U.S. Treasury borrow all the money that it needs to borrow? I think they're going to continue to let the Caymans lever this thing up until it blows up, and they're going to hope that these primary dealers can have enough dollars on hand to stop a stampede. I think that's literally their plan, which to me is just clown world. So yeah, I'm all in on gold and gold miners. In case you guys didn't know that or hadn't figured that out yet, I think I'm going to wind up buying and selling just about everybody else around me because I don't think anybody sees this coming. I don't think anybody sees this coming, and it's here. They've started QE, but they're not calling it QE. And another thing I will point out is Peter Schiff was on the Fox and Friends show at like 6 in the morning on a Saturday morning, and apparently Trump was up, and he doesn't tweet because he's on Truth Social, but he tweeted on Truth Social, who is this idiot Peter Schiff? And I think we need to have a word with the editor or whoever allowed him to get on the news at Fox News. So he's playing very dictator-like there. But I talked to a friend of mine from Oklahoma, old college buddy, and I know he's a big Trump supporter, and I think he watches a lot of Fox News, and I don't think he thinks that inflation is going on. Well, when I went to Walmart, those goods that I bought were 9.1% higher versus a year ago on average. So the inflation's definitely real, but we will see what happens. I got a feeling this trade's going to blow out on the conspiracy trade. Maybe I'll wind up surviving. But that's it for this time. We're going to keep this one a little bit shorter than some of the other ones. We're at about 22, 23 minutes. So thanks for listening, guys, and we will be back with podcast number 12.